Hamish, you're good to go.
All right, welcome everyone. Glad everyone could make it. My name's Hamish Morris. I'm one of the senior currency strategists at OFX. I guess welcome to OFX West London, one of our regional offices. What we're going to be doing today, well, this is OFX's latest webinar on how to manage FX risk. It's a couple of webinars we've been doing over the last or for a while really, and I think it's really pertinent that we're doing one at the moment. This webinar will be recorded and available, sent out very shortly afterwards, otherwise early next week, for you all to listen. And if at any point throughout the webinar you have any questions to ask, please input them in, and we'll strive to get through as many of them as possible, either throughout the webinar or towards the end. So I'm joined by my esteemed colleague, Alex Hartley, who I think you can see. Wave, Alex. So Alex has been at the business for around about 15 years now. And what we do is that we work with companies all across the UK and Europe, really, helping them manage their FX risk. And what we found a lot recently is clients coming to us and going, Hamish, what is going on with sterling at the moment? What's going on in the market? So we thought we'd bring all of those questions together, answer them in all sort of one fell swoop, as it were, and that's the webinar today. So with that being said, we're going to take a look at the following, really. So first of all, what's been driving the pound recently? We're going to look at the pound against a couple of its key currency pairs, sterling euro, sterling US dollar, obviously a couple that stand out. What are the banks saying in terms of their forecasts? And then if businesses, as a lot of UK businesses are, worried or concerned, what can businesses do to manage some of that uncertainty and some of that risk moving forward? And then finally, as ever, we're going to leave you with 5 top tips to take away. And these are tips I think that are really useful to businesses, not just at times of uncertainty, but generally all the time as well. And just before that as well, I think I'll bring in Alex just to answer some FAQs, some questions that we get thrown our way all the time. So that'll be Alex's chance to shine. So what's been driving the pound recently? So we've seen since March a bit of a pickup in sterling. We saw those lows against the US dollar, a big influx into the US dollar in March, as the market really rushed to those safe haven currencies and those safe haven assets. US dollar, Japanese yen, Swiss franc, they're the ones that really come to the fore. But the pound's really being driven at the moment by 3 things, I'd say. First of all, we've got the UK government's reaction to COVID-19, the coronavirus pandemic. Secondly, you've got arguably wider international moves and risk on, risk off sentiment. There's been a decrease in FDI, or foreign direct investment, into the UK over the last few years, and I think that's had an impact on the pound as of late. That's a big player at the moment. And then thirdly and lastly, Brexit. That's obviously playing a big part in that sterling story that we're seeing unravel at the moment. So we've seen sterling US dollar is tried to make a breakaway, but fundamentally there's a number of risks that really remain for the pound, and these are really indicated by some of the indices that we can see on the screen here. If I'm honest, if I'm frank, a couple of these aren't indices that we'd normally keep an eye on, but because of where we find ourselves at the moment, we're looking at them more and more as indicators as to where the UK government is in its current sort of pathway. So the first one there, UK services PMI, absolutely crucial for UK GDP. The services sector makes up around 78% of the country's GDP, so it's very, very important. Now that number there, we'd normally expect that to be above 50. Anything above 50 shows an expansion in the sector. So 29, really, really damaging and shows a big contraction instead. It was actually lower in April as well. The second one up there, UK average house prices. Not something that we'd normally look at. Doesn't normally play a big part in the demands and swings for the pound and other currencies, but UK average house prices really paints a picture of what's going on behind the scenes in many ways. If people's houses are falling in value, ultimately their debt as a sort of percentage of that is increasing, and it's a lot of UK households, you know, they own or have a big mortgages, and if your house price is going down, obviously you've got to tighten the belt elsewhere. We can see that consumer confidence is at a 10-year low, so that's very, very concerning as well. UK GDP, well, that dropped 2% in Q1. We also had that whacking great big fall of 20+%, 20.4% in April. And the difference, and I think what paints a really, really good picture as to where the UK is at the moment, the difference between our February output and our April output is -25%. So very, very significant. That 20% drop as well, just to give you some context as to how large that is, between 2008 and 2009, those sort of 13 months at the peak of the GFC, the global financial crisis, we saw a 6% contraction. So 20% in 1 month is pretty mammoth. Unemployment claims, that's picked up to 2.8 million. It's pretty large. Something again that we for the last number of years have really not sidelined but focus our attention elsewhere. We'd expect that number to sit around 800,000. It's sat around 800,000 for the last 6 or so years. So there's been a big jump up, and now 125% increase since March. And then obviously 9.1 million people on furlough at the moment. That program set to come to a close in October. So the pound looks like it might be doing a bit better than it was, but risks really do remain on the horizon. These risks are really reflected in what's been going on in sterling recently. We've had that consolidation following March, April. Pound US dollar is trying to make a run towards 128, but there's a couple of things that's been playing out. Obviously, that US dollar acting as a big safe haven currency. There's been some suggestions that the US dollar is losing that safe haven currency status, but over the last sort of week or so, I think that story is really reversed. US dollar is the safe haven currency that everyone wants to hold. The euro, well, that's the new one. That's the new safe haven currency as well. And sterling euro is not really consolidated or recovered as much as we'd like to see. The euro is also largely supported by that two-pronged approach. Firstly, from Christine Lagarde at the ECB, bring around big monetary stimulus, and then we've got this big report of an EU-wide fund, something that we've never seen before, 750 billion euros, and it's literally this morning they're beginning to hash out those details, and it'll be really interesting to see whether a couple of the more frugal nations sign up to that program. But the markets really welcome that big two-pronged approach from Europe, and we've seen quite a bit of euro strength and some suggestions that the euro is becoming a bit of a safe haven currency as well. Now, what really paints the picture for the pound and the place it finds itself in at the moment is if we compare it to other currencies and the performance of other currencies. So just stepping away from sterling for a second, it's not recovered to a great extent compared to things like the euro. So euro dollar, that's bounced back from those March lows. The loonie or the Canadian dollar, that's recovered. So dollar CAD, that's dropped back down. The Canadian dollar's doing pretty well at the moment. And one of the currencies that we hold dear and monitor very, very closely, the Australian dollar, that's having an absolute stormer against the pound at the moment. Similarly, having an absolute stormer against the US dollar as well. So a lot of these other currencies, and that Australian dollar currency is very, very sensitive to that risk environment, being one of the major commodity currencies. Just all of these other currencies recovering doesn't paint a great picture for the pound at the moment, and goes in with the story that there's a risk still on the horizon for sterling. And what I'd say is that maybe the recovery in the pound, there isn't a lot of legs in it really. Well, is there any hope moving forward then? One of the difficult things that we found over the last couple of weeks is drawing a comparison. Arguably, 2008, 2009 is better than 2016, but it is difficult to draw a comparison to what's going on at the moment and the global financial crisis. But ultimately, there is some similarities. So we had the FTSE dropping 30 odd percent. The FTSE's bounced back recently. I had a big slide in pound US dollar, almost 35% back in 2008. Never really recovered from those levels. And then UK interest rates, well, they've never really recovered, but we've seen a similar thing happen. So there was a big slashing of interest rates back in 08. I think they slashed them by over 5%. They went from 5.75% down to around about 0.5%, and we're now at lower levels. So we've seen the Bank of England cut rates again, and just yesterday we saw the Bank of England increase that quantitative easing and stimulus, that monetary stimulus. That was something that we saw in 2008, 2009 as well. And then to get the country up and running again, big increase in government spending, and national debt actually doubled between 2008 and 2011. So the government had to spend to get the economy up and running again, and debt as a percentage of GDP that you can see there, it increased as well. The one that really stands out for me really here is that unemployment rate, 8.1%. So before COVID and before the coronavirus hit, the UK was actually at record employment levels, and unemployment's much lower. But it wasn't until 2011 that unemployment rate peaked, and that could be something that we see following the sort of coronavirus recovery. It could be a while, and we could have that lag effect before unemployment rates drop back down. Why is that significant? Well, it's quite clear. So let's talk through it. So if more people or less people are in jobs, obviously there's less spending, people tightening their belts, spending, less people on the high street, lower GDP levels, and ultimately, the Bank of England, if people aren't spending, they're not going to be worried about inflation rates picking up too high and interest rates following as a result to pull those inflation rates back down. Actually, the Bank of England said yesterday that inflation won't pick up back to its sort of desired 2% range for quite a while. So 2008, 2009, different picture, but it gives us a bit of an idea as to what the UK could be facing moving forwards. It was different, but I think what's important to stress here is that ultimately globally we recovered, and the UK recovered, and the pound recovered to a large extent as well. So it's not all sort of bleak at the end of the tunnel. There is light at the end of the tunnel still. So what should UK businesses be looking out for then? What we've done here is that we've overlaid some of the key milestones that we think are important over the next sort of 12, 18 or so months, and we've put them on top of the sterling euro forecast that we've pulled recently for 2020, for the rest of 2020, and for 2021 as well. And there's a couple of key milestones. There's a big risk on the horizon that's very apparent. But starting at the beginning, pubs reopening. Why is that there? Well, obviously it's very important, obviously. But it's key, and I think it's a key milestone because it signals people back on the high street, people spending their money again. Hopefully, we see the pubs reopening at the start of July. But as mentioned, it's people back on the high street. And it could be the beginning of the end, or the beginning of the end of sort of a coronavirus exit plan. So great news, possibly around the corner, and a key milestone to look out for. Then autumn, we've got two things there. We've got furlough ending. We could see if hopefully UK businesses are back up and running and able to support their employees, but we could see a pickup in unemployment and claimant benefits as a result. But the other key point there is that the UK tourism industry could get unlocked. UK tourists love to go abroad. Most popular destination is Spain, but we could see domestic tourism unlocked as well. And again, that's just more spending, people out and about, more consumer confidence, great for UK GDP, great for the pound. Now, interestingly and importantly, we've got Brexit here. So obviously that's a big risk event. It's no surprise that come the winter, we could see a tail off in those sterling euro forecasts. Now, a lot of the businesses that myself and Alex have been talking to recently, are looking at that Brexit risk quite narrow-mindedly. So just looking at two dates. So the first one is the end of this month, when that's the last point where the UK can agree to an extension to that transition deal. So that's the end of June. And the second date that a lot of businesses have in their mind is the end of December, when the UK is set to leave the EU, end of the transition period. Now, I think what's really important to stress is that there's any point between those two times, Michel Barnier or Boris Johnson could stand up in front of a podium in Downing Street or Brussels and announce that the UK hasn't agreed a deal with the EU and will be leaving the EU and a no-deal Brexit scenario. That's not going to be limited to those two dates I've just mentioned. It could happen August, September, October, November, and that's really important for businesses in the UK and Europe to bear in mind and remember. Obviously, if that announcement is made, hopefully we have an extension to the transition period, or a deal is knocked out. But if that's not the case, and we have that announcement that the UK will be leaving in a no-deal Brexit scenario, expect the pound really to weaken. We could see weaken to an extent and then consolidate slightly as investors scramble and realize, well, wait a second, haven't we got some legislation in place that stops us leaving a no-deal Brexit? Boris Johnson, let's go back to the House of Commons, let's go back to Parliament, let's hash this out. But we know that the FX markets move very fast, and before that is established and before that is in place, we could see some severe sterling weakness. And I really think that is really reflected in the limit to the upside for those sterling euro forecasts. And then moving into the spring 2021, well, one of the big risks that the pound and UK faces is if we're stuck between our coronavirus recovery and Brexit. And the Bank of England are sat there in the middle going, what on earth can we do? We can keep interest rates ultra low and keep pumping money into the economy or into the system through quantitative easing. Internationally, though, if we have the ECB and the Federal Reserve beginning to look at tightening rates or taper their quantitative easing, that immediately makes the pound less attractive to those international investors. So The Federal Reserve, I think they're quite clear is that they're not going to be raising interest rates anytime soon, but and the dot plot and their forecasts certainly point to that. But come 2021, if they begin initial discussions of maybe the end of 2021 or 2022, we could begin to raise rates again. The pound really will find itself on the back foot. And the same could come from the ECB as well. Something really important to bear in mind: if other central banks begin to raise their interest rates, and the Bank of England is left behind, is in a different world and different scenario, then the pound fundamentally become less competitive to international investors, and we'll see some sterling weakness as a result.
Hamish, we've just had a couple of questions that are quite pertinent to this section.
Fantastic.
Will central banks run out of money to pump into the economy?
Will central banks run out of money to pump into the economy?
Yeah,
that's not going to be the case. Really, I'm not Christine Lagarde or Jerome Powell, but there's ultimately, if they want to keep on pumping money through quantitative easing and those bond buying programs, they're going to keep on doing it. The important thing, though, and what Christine Lagarde has been really good at, not saying that Mario Draghi was necessarily a bad governor of the ECB. He did a very good job of rescuing and saving the euro at the height of the Greek crisis. But Christine Lagarde's brought this political approach as well, and she's managed to whip European policymakers in place and bring that fiscal stimulus to the table as well. I don't think the ECB or the Fed are going to run out of money to pump in. Ultimately, the pockets are as deep as needed. But the key thing I think we're looking out for is what comes as fiscal spending as well. There might and there could be a limit to that. Are there any other questions as well, Charlotte, or is that the sort of encompass both of them?
I think if we just do one more in this section, do you feel long-term interest rates will remain low?
I certainly hope so, for mortgages' sake. Yeah, in all seriousness, I think long are the days when interest rates were at the giddy heights of 15% in the UK. And the reason I say that is that we've gone from, ultimately, it's been a surprise, but 2 economic cycles. So we've gone from 2008 to now, and interest rates never really recovered. They never peaked back up to the sort of normal 5-7% range that might be expected globally. It didn't happen anywhere. So I think now the new norm is ultra low interest rates, and we won't hit those giddy heights that we've seen before. I think we're fortunately for UK mortgage owners, it's not going to be the case. Not so great if you're a big saver though, instead. So obviously there's the great questions, and it just goes to show that the amounts of uncertainty that there is out there, and businesses are concerned. And what I think, moving on to the next slide, what I think is really apparent is it's not just UK businesses that are concerned as well. It's UK banks are really unsure as to their forecasts, and this can really be seen and reflected in the spread of forecasts that we get provided with. So Q1 2021, sorry, really not too far away. The year is absolutely flying by, but the banks are forecasting almost a 20-cent range as we start next year. So a simple business, as we can see from the example here, a simple business that's got a $100,000 invoice to pay could be something like a £19,000 difference. And I don't care, it's no matter what size business you are, that's going to ultimately add up and make a significant cost or saving to your bottom line. So UK businesses have a level of uncertainty. UK banks do as well, and they're not sure as to where the pound is going. Ideally, and the normal scenario and circumstances as well, we'd see the band between the upper level and the lower level be much narrower. It's been a while since I've seen sort of a 20-cent range 6 months out. We'd normally expect that forecast to be much more uniform moving forward. So it just goes to show the level of worry perhaps, and it's just how the UK will recover, and just to the extent to which the US dollar will act as a big demand, a big safe haven currency through the year as well. And I think the same can be said for that sterling euro forecast. So come Q2, come the summer of 2021, that's a 12-cent range. That's pretty significant, and you just bear in mind and remember how sterling euro doesn't trade to such a great extent as pound US dollar. So a 12-cent range and having that big sort of spread in forecast is quite significant for sterling euro. In the same example there, or 100,000 euro invoice could be a difference of sort of £12,000 being added to your bottom line, or a cost to your bottom line instead. So one of the things that we get asked a lot, myself and Alex, and I'll bring Alex in just a minute, as mentioned, is what should we do about this? How can we manage this? So if you're at all concerned about where the currency markets are heading, whether it's pound, US dollar, euro, one of the best things and one of the great things you could do is look to hedge your exposure. Take that risk off the table and hedge that exposure. Forward contracts allow you that. They allow you that flexibility and those options. And so one of the strategies and approaches that a lot of our clients have found really beneficial recently, since the start of the year, ultimately, or since March, is tapering their forward contracts as the year moves out. So there's a really simple example here. If you're renewing your sort of forward contract strategy or risk management at the start of the year, you might look to take out more protection come January, February, March compared to October, November, December. Now, the real great benefit to clients and businesses is this allows more protection and more certainty in the short term. At the same time, if the interest rate, or if the exchange rates rather, begin to move in your favor throughout the year, you have the flexibility to top up those levels for October, November, December, or any of those other months, top them up with and increase your hedged positions, or indeed purchase or sell your currency on the spot market as well. So the big advantage, I'll stress again, the big advantage, tapering your forward contracts, certainty in the short term and flexibility in that medium and long term, really useful. And as mentioned, a lot of our clients are finding it fantastic at the moment, given that level of uncertainty. And ultimately, as said here, you can really begin to improve those average exchange rates across the year. But why stop there, though? I always say use all the tools in your tool belt, and it's absolutely fantastic to utilize not just spot contracts, but forward contracts and limit orders as well, and look to blend them. So these are really advantageous, and we had a lot of appetite for them in December last year, during the UK election. And limit orders are great because they remove that human element to a great extent as well. Businesses don't have to constantly be looking at the exchange rate markets and the FX markets. They can set their desired target rate, and if that's hit, that order will automatically and electronically trigger, and then they can be rolled into forward contracts as needed. And the great thing about limit orders is they take advantage of that volatility. So the levels in the FX markets that you see 9 to 5 aren't necessarily reflective of what you might see overnight. And the reason that is that the vast majority, and this really is very much the case of businesses in the UK and Europe, so the vast majority of FX is traded through London. Fantastic. But obviously the FX market's constantly going. So we see a lot of volatility from sort of 6 p.m. to 6 a.m. And the reason is that there's less liquidity in the market. Smaller ticket trades can have a larger and greater impact. This is particularly the case overnight, particularly from the Asian markets as well, where there's a bit less liquidity. And I think, funnily enough, it's great that we're doing this webinar today because it's big session wrap up in the US today in New York. So between 3 and 4 p.m. New York time, which I think is 8 or 9 p.m. London time. There's a lot of contracts, equity contracts, option contracts, FX contracts expire. And we can see a lot of volatility. That only happens a couple of times a year. See a lot of volatility, and it's called a witching hour. And we can see big spikes in the FX rates come 3 to 4 p.m. close New York. And limit orders are great because they take advantage of that volatility. Now, the other thing that we do, which is great, is that we run a follow the sun business model. So we've got offices across the world, and we've got treasury dealers across the world and treasury management teams across the world. So we're able to constantly monitor and constantly fill our client orders, whether that's our teams in Sydney filling our clients' orders in London, or indeed our treasury dealers in London filling them on behalf of the clients in Sydney. So we're constantly able to monitor them and ensure that our clients are getting the price that their limit orders are set at. And that's ultimately because we do have that follow the sun business model. Why stop there though? On the downside, so limit orders are fantastic if you want to take advantage any exchange rates that are in your favor. But if you're at all concerned about exchange rates out of your favor, well, stop loss orders are a fantastic tool as well, and they act very similar to limit orders. So these work great if you're a business that's got strict and stringent budgeted levels. So in this example, if you're an importer, maybe importing car parts from the Far East and you're having to pay for them in US dollars, if you're at all concerned and maybe your budgeted level is 120, you can set a stop loss order at 122.70 to ensure that your currency is purchased before you get too close to that risky budgeted level. And you know that throughout the year you're able to purchase your currency above your budgeted level. Now, stop loss and limit orders as well, they can often work in tandem and work as OCO, or one cancels the other. So you can put two orders in the market simultaneously, and if your limit order hits, then your stop loss order can be cancelled. Same with the other way around, and that's just to ensure that obviously clients don't double up on the amount of currency that they're purchasing. But as I say, I reiterate again, it's really great and it's fantastic. Clients should use and businesses should use all the tools readily available in their tool belt, and these are all the ones that or some of the ones that we offer, and blending them all in one ultimately helps bring together sort of a more rounded FX management strategy. So just bringing Alex in here. So Alex, as mentioned, these are a couple of the questions that we get asked quite frequently. Why is my spot price different to my forward contract price? That's a really good question.
Thank you, Hamish, and good morning, everyone. Yeah, so good question. One that gets frequently asked. Why do we see spot difference versus a forward price comparison? There's a number of reasons why. So first being the interest rate differentials between the two locations. I use the example of South Africa. So South Africa that's seen a sort of 5 to 10% interest rate over the last 10 years versus the UK that's obviously now sitting at 0.10. You'll, with the interest rates differentials on a 5 to 10%, if you're going into the South African rand, you'll see a value difference. Now, obviously, because you're not gaining interest on the funds sitting in a bank account, what actually happens is it gets factored into the rate of exchange. So obviously going into South African rand, there'll be an increased value. If you was coming out of the South African rand into, say, the pound, you'll see a decreased in value. So it'll be a variable difference from the spot value, which is obviously an immediate settlement. Another reason may be the type of forward contract you've taken up. So obviously, if you've gone for a fixed or a variable forward exchange, then you'll see a value that remains consistent through the transaction. And or obviously if it's variable, it will move as the interest points are taken or added. And then last but not least, and a lot of people don't tend to realize this, but is due to the risk. So obviously if your forward exposure is quite large, say on the major currencies, you're talking $1 million plus, and on some of the lesser currencies, probably anything from around 250 to 500 above. The banks and obviously the markets don't like the risk of having no payment against such a large order. So what they tend to do is they tend to take a larger margin on the offset. So then when obviously the price gets sold on, you'll see a value difference that may be greater or worse than the spot value. So that's some of the answers to question one. Question two, obviously what happens to the pound in the next couple of weeks. So I'm sorry to disappoint you if this is one of the main reasons you've come to get an answer to this question, but who knows? And the reason I say that is because obviously there's so much that you could take into consideration within that time span that could obviously affect the currency pair. Obviously, what we tend to do at OFX is we look at what's available to us to be able to give an educated viewpoint on where the markets may move. So number one, we would look at the trend, obviously what's happening with the currency pair at the moment. Obviously, pound's a little bit off the boil at the moment, say against the US dollar and euro on the basis of yesterday's announcements mainly. But obviously that would be one point. Second point is we look at the fundamentals. Fundamentals would be taken into consideration such things as the latest GDP figures, employment figures, as Hamish rightly points out, is very important, and things such as services and manufacturing PMI data, which obviously depending on the result against the forecast will normally send the pound higher or lower independent. And also sometimes we see movement in anticipation of the release. So you'll see buy the rumor, sell the fact around that same sort of time. The other one is technicals, which enables us to look at the market movement over a chart. And what we normally get given is a sort of look at resistance and support levels. Now, so look at the current rate of exchange, and then it normally gives you 3 target prices higher and 3 target prices lower, which will take into consideration data that's due and other such things as like that, which then enables us floating back to what Hamish said about limit orders and obviously stop losses or OCOs. If you put the 2 on, it just enables you to give you a more educated viewpoint as to what target prices you should be looking at, rather than sort of pointing your finger at a board and trying to work it out from there. It gives you some levels to work with. The other one, and one I don't like as much is, and unfortunately we've become a bit of a nation to follow this kind of viewpoint, but is headlines. So now obviously if Donald Trump drops a tweet, or the Daily Mail puts a significant headline on, the markets have a tendency of being swung by announcements like that, which then obviously makes it a lot more difficult to take a viewpoint or take into consideration what may happen. And that's why those tools are available for you to try and offset that risk. And last but not least, another question that gets asked is what happens to forward contracts if the dates change? Well, at OFX, we are incredibly flexible with how we manage our forward contracts for our clients. Not only in the uptaking of the contracts that Hamish explained, you can vary your forward contracts to match your requirement, but in the sense that if you did reach a maturity date that you could not meet, either that you have an order brought forward, so you need to deliver earlier, or obviously an order delayed, so you have to extend it to a little bit, like we would be able to do so. If those dates tend to be very short-lived, so delivered within a month or extended by a month, the variable difference on the rate of exchange is very minimal. But obviously you have the availability, so it's not a concern if you get to maturity and you're as most recent events have occurred, that your goods are stuck on the port of China, that you can extend and manage your margin, your market risk at that stage. Back to you, Hamish.
No, brilliant. Thank you, Alex. Yeah, I think
Hamish, to cut you off, sorry to jump in, but we do have some audience questions that maybe we'll do now before we go into the poll.
Yeah, definitely.
So over a medium term, will a retreat from globalization mean more manufacturing in the UK and less of a reliance on service sector importance?
Is there more than one question I can take, or shall I? Let me go for that one first. So, a retreat from globalization. So that's a really, really good question. I think what's important to realise that the service sector, obviously that is the main contributor towards sort of GDP at the moment, and within that, financial services makes up a large part. But services includes things like pubs, restaurants, and which still will remain fundamental towards the UK economy. With regards to manufacturing, the UK has constantly had, or for a long time, it's had that current account deficit. So we import a great more than we export, and I don't think that's sort of going to change in the medium term. So let's say the next sort of 3 to 5 years. If anything, I think the UK will be even more reliant in the medium term as a result of Brexit on those imports and those sort of manufacturing from the Far East or overseas. The UK's just struck a great trade deal with Australia, for example. Got Tim Tams coming in. It's great to see. I know that the UK OFX office is going to be very happy about that. But the point I'm trying to make is that I don't think sort of the UK manufacturing sector is going to see a big boom in the medium term as sort of globalization perhaps wanes and the popularity of globalization wanes.
And then another question, and this one is potentially for Alex. On a forward contract, am I right in understanding that I can change the amount I hedge as the year goes on?
The value that you can deliver on, you can. So if you, for example, took up a 6-month contract for $100,000 US, obviously if your end value is 120, so you underbought, for example, you would buy the remainder at spot. You wouldn't be able to increase the forward contract itself. However, obviously, if you got to the end of the 6 months and you had overbought, so you bought 100,000, you needed 80, you would deliver the 80,000 that you needed to, and then would be flexible in extending the 20,000 that was left over.
I think that ties in. That question might tie in with the tapering approach that we were talking about earlier. So, if a client, as an example, had it in December, it hedged $50,000 US for December, but the exchange rate maybe improved, they could. Am I correct, Alex, in assuming that they could increase that December hedge to maybe double it to $100,000 US?
Yeah, from the offset, if they were hedging their exposure over the year and they wanted to obviously take up the tapering option, that would be a possibility. Yeah.
Okay. I think next. Sorry, Charlotte.
Yep, that's all for now.
Yeah.
Cool.
So I was just going to say next. We've got a couple of poll questions, and this is something that I think it would be really useful to get an idea of. So, what's the biggest concern your business faces when it comes to foreign exchange? Brexit, COVID-19, cash flow is obviously very important, something that we can help with. The US election of Trump versus Biden, that would be very exciting, and advanced pricing. So just give it a moment to for those poll questions to come in, and then I guess we'll run through the responses.
So we'll just give it a couple more seconds and I'll close the poll. I'm just seeing that people are starting to vote. Okay, you should have it on your screen now, Hamish, the results.
So that's really interesting, actually. So well, it's a bit smaller than I can read. So Brexit, 25%. That's no surprise, obviously. Sort of, I think a lot of the people listening, UK clients, UK businesses. So Brexit's obviously pretty significant. Cash flow, well, that's something that we can, if that's a concern at all, we can help with that. So obviously we talked about for contracts and often we can provide flexibility with clients that we work with to alleviate some of those cash flow concerns. disappointingly, or I guess rather reassuringly, the US election isn't up there. What I would say there, though, is that whoever wins that US election, that's going to have a big impact on the US dollar and as a sort of global currency. The advanced pricing is the most significant concern. So not too unsurprising there. Bit of a mix really, but just goes to show that there's a lot of things that UK businesses really have to keep an eye out for. I often feel really sorry for FDs and CFOs. Not only are they concerned about FX rates, which are very important, obviously, but they've got all these other facets of their finance team and problems that they have to worry about as well. Which is why, you know, utilizing a service such as OFX is great, because we can come in and act as that. And one of the great benefits is we can act as that extra hand, that extra treasury person or extra accounts person for free. Ultimately, you know, we're not coming to the office literally, but we're there adding some help, adding some value to finance directors, CFOs, business owners. So I think that's a really good point to move on. So what should UK businesses be doing? Well, you know, these are some top tips, and this is something that we've suggested for a while, and I think they're really pertinent and important anytime, but particularly at the moment. So the first thing that's absolutely critical is to stay on top of all the events. Businesses need to be doing this. You don't want to let, you know, coronavirus or Brexit go past and affect your business without realizing. We provide a daily commentary for all of our clients, and it's free to sign up to. And we also provide bespoke analysis, bespoke updates for all of our clients when necessary as well. Secondly, talk to a currency expert. Often with big market swings, new opportunities, new corridors can be opened up, and new competitive advantages can be presented. So if we see a big spike in something like pound, Australian dollar, perhaps it opens up a new opportunity for your product or your service. Thirdly, this comes back to what I said earlier. Use all the tools available in your tool belt and look to blend and, you know, amalgamate them all in your FX risk management strategies. That's spot contracts, forward contracts, limit orders, stop loss orders. Bring them all together and utilize them all, because they all complement each other really well. And you find that that's a really great simple thing to do to improve those average exchange rates as we move throughout the year. And finally, have a plan in place. Don't leave things to chance, and don't leave things to the last minute. So I always say you wouldn't buy your home insurance when your house is already on fire, and I think that applies really well to FX and FX risk management, particularly at the moment. So don't leave things to the last minute. And I guess I think that brings us to a close. So it's been really great talking. Hopefully that's answered loads and loads of questions. Myself and Alex's contact details are up there. If there are any other questions that we didn't get to, we'll come back to you offline, as it were, and there'll be a recording of the presentation put online as well. Well, I'd just like to say thank you to Alex for joining us today. Thank you to Charlotte, who's been busy working away in the background, helping us get this up and running over the last sort of 5 or so days. So thank you very much for coming to listening, and enjoy the weekend. All the best.